and we rapid speed down to 2,500.
Good point, wherever you reduce speed to 180.
Blackbox.
Hey gang, welcome back. This is part 2 of a 3-part series where we're talking about 2 of the most exciting topics on the planet. Life insurance.
Yeah, thrilling.
And annuities.
But it's good to understand them.
Yeah, I think it's probably 2 products, as we said in the first show. It's probably 2 financial products that's most misunderstood.
Yeah.
And so over the past few months, and I would even go, I've been at this for about 28 years now. And inevitably, weekly, when I'm talking to clients, there's always misinformation that's spread about these 2 financial products, probably more so than any other financial products in the marketplace. So you and I were talking a few weeks ago, and we're like, hey, why don't we just really produce some really good content that's open architecture, absolutely. We're going to give you everything we know to give you.
Yeah, do our best to dispel the rumors.
Yeah.
Right?
And the best way to approach things that you don't know is get some education. And I know there's a lot of stuff on YouTube out there and other platforms that people are, promoting, pitching different types of products, the silver bullet of life insurance, the silver bullet of fixed index annuities. And so we want to just try to put some of that at rest. Now, I'm not in opposition to those products. I just want to make sure that people have really good information before they make a financial decision of whether or not it's appropriate for them to own these type products in their plan. And I know I'm going to probably shock a lot of my friends out there saying that it's not for everybody.
Right, yeah. It's not a one-size-fits-all.
Yeah. Definitely, if you're uninsurable, life insurance, you can skip over this video. Mm-hmm. Because if you're uninsurable, it's not even a topic for you to discuss or to try to consider in your plan because it's not going to be available to you.
What would make somebody uninsurable?
Man, it's a great question. So insurance companies rate you on your health, your finances, your lifestyle, things you choose to do. Mm-hmm. And if they're dangerous avocations, like you were in Special Forces, in your early years, it was really hard for you to get insurance. Because
I skydived.
Right.
Yeah. Well, that was one of them.
That was one of them.
Right.
And then the other stuff that if you told us, you'd have to kill us all, right?
Yeah.
So, in all seriousness, Shannon was in Navy Special Warfare, and he had a dangerous job. As a matter of fact, you almost killed yourself on a boat once, right?
Yeah,
So
times, yeah.
I'm sure the insurance company loves to hear that.
I love that, yeah.
But as an example, dangerous avocations can exclude you while you're in those dangerous avocations from getting issued a policy. And here's the big news. Insurance companies, even the not-for-profit ones, don't want to pay death claims.
Right.
They are in the business of not paying death claims. Or if they're going to pay them, it has to be a benefit long-term for you, the consumer, and for them, the institution.
So the juice has to be worth the squeeze for the institution.
Bottom line.
Because it's a transfer of risk, right?
Right.
Yeah.
And that's a word or phrase that you'll hear us say a lot during this podcast or education video is transfer of risk. That's the definition of insurance. Investments, on the other hand, is the acceptance of all risk. So anytime you invest in something, there's an acceptance of risk. Mm-hmm. Anytime you transfer risk, that's typically going to refer to insurance. Now, that in and of itself, we'll get deeper into this part of it. Life insurance, drum roll, is not an investment. right?
I had to, yeah.
It's not an investment. It can be used to supplement your investments, but it is, first and foremost, when you buy it, you're buying an insurance product. And if it's life insurance you're buying a life insurance product to transfer some risk. If that's not your first and primary objective, again, I go back to, is the juice worth the squeeze?
Right.
There's a lot of people pitching life insurance out there as this great tool or strategy for retirement planning as if it's better than the equities market. Another drum roll. Here we go. Kenny's going to say it. It's not better than the equities market when you peel the onion back of rate of return. And I know I'm going to shock some people with that. And it's going to sound like when I start showing some illustrations, they're going to appear to have a forked tongue. But I want everyone to keep it in the context of, well, what is the reason you're buying this product? What is the reason you're buying a mutual fund or an exchange-traded fund? Understand what you're buying and the purpose behind it. What are you trying to accomplish?
And to that point, and I'm sure we'll hit on it as we kind of go through our pages here, but when we look at the transfer of risk, one of the things people watching may be wondering is, what risks are there?
Yeah.
So you have asset risk, income risk. They think about a married couple,
Yeah.
right? Using myself as an example.
Okay.
Retiring last year from the Navy, I chose not to go with survivor benefits. Oh man, that's a big decision.
Right.
But instead, take what my survivor benefit payment would have been, calculated what my retirement is, or what my wife would have received over a number of years, and then came up with our economic life value, which we spoke about in the last podcast. Right. And that gave us the sum of money that we would need to replace my income.
Right.
So protecting or transferring the risk of income loss.
And you did it strategically where you're renting the coverage in the early years with strategies built in to convert it in the later years.
Right.
So build your asset base up, allow the assets, the investments to help you fund the future purchase or ownership. And so those are two things we're going to talk about, Shorty or Shannon. God, I always have to tell people, why did he just call you Shorty?
My nickname's Shorty.
Yeah,
Just so.
okay. So it's Steven, Shannon, Shorty, Short Ridge, Quad S.
Yeah. Excuse me.
So
Sorry.
there's the form of renting coverage, and there's a form of buying or owning coverage. And there are phases in life where both are important. Now you're going to have people stand on both sides of the fence here, where you're going to have the Dave Ramseys of the world who will absolutely stand on their buy term, invest the difference. That has a place. I'm not saying David is completely wrong there, but he's got a lot of things that aren't clear, and they're not absolutes. And sorry, Dave, it's not an absolute that everybody should buy term and invest the difference. Yeah. So we're going to try to dispel some of those myths. And we're going to give you some links in this video at the on YouTube where you can backlink or hyperlink to one. I wrote a white paper that's going to kind of condense this conversation for folks who are interested in buying or owning insurance. I wrote a white paper that you can read. We'll also put a third-party document in the links from Ernst & Young, who did a paid study, right? They were paid to do this study. Yeah. And some people would say, well, if they're paid to do the study, then, they were bought to say what you wanted them to say. And I would go, okay, to each his own. Yeah. But they're really good studies that goes and looks at the math, and you can't dispute the math, of whether or not, and depending on what phase of life you're in, how you should purchase. And actually, you're bringing that study up right now. So this study, we'll have it linked in the podcast here for you.
Want to pop that up there, Jake?
And so you'll be able to see here the benefits of integrating insurance products into a retirement plan. And this also goes into, I call it the trifecta of investments, life insurance, and annuities. And the study that looks at those three products interwoven in a retirement income strategy. And so I think it's a really good piece to educate yourself on.
Yeah.
And know before you buy.
Absolutely.
So we'll come back to that. So let's start, Shannon, with
Good, Jake.
the history of life insurance. So we've came prepared today because there's a lot to talk through, and I'm going to use my notes here to try to keep us on track. But historically, if you think about life insurance in the United States, that goes back to the mid-1700s. And it started with a group of Presbyterians, Presbyterian ministers who wanted to kind of take care of the flock or each other as pastors in their noble calling to lead their churches. The organization of Presbyterians set up the Presbyterians Ministers Fund.
Sorry.
And history says that was around 1759. So that was the first documented case of individual life insurance in the U.S. And it was designed to provide financial support for families who might lose their income earner and a way to replace the income. So that's the first primary tool. If you're going to buy life insurance, what are you buying it for? Is it to pay off debt? Is it to replace income? Some spousal support. There can be reasons for savings and accumulation, and while you do that, you're just having
Keep
a time
going,
there.
man. I got something in my throat.
Okay, hey, we're going to pause for a sec.
Sorry. I got something like stuck in there, man. It's like not going away. Yeah. Anyways.
Jake, this is when we will edit, so.
God dang it. All right.
Get it all out.
Trying. Good. I sat down and my nose started running, and then I instantly started coughing. I don't know what the.
Just as long as you don't start crapping yourself over there.
I already did that.
Yes. Yeah, seriously, we'll edit this part.
All right. Sorry.
Make a note
Try
at the
to keep it in.
timestamp where that happened, Jake, so it'll be easier to edit. Yeah. Okay, we're back. Shannon almost
Episodic,
died. We're talking about life insurance. He almost died on us.
Yeah.
So hopefully he's okay now.
Yeah.
But we may have to gurney him out of here.
God, I hope not.
So we were talking about Presbyterians Fund. That was one of the first documented cases of life insurance. And then as we kind of go into the evolution of life insurance, it became a institutional product, and big institutions started getting involved in this arena of protection. And it made a ton of sense, as we turned into a sovereign nation and as our country began to grow and men were going into the workforce, and then traditional homes, women were at home with children, there was a risk that if the bread earner lost his life during that period, that the society had an issue there. Mm-hmm. So it was a great societal benefit to provide some relief for a mother and her orphan children in the event of losing a spouse. So that was the early periods. Now, as time goes on, these private institutions who are for-profit, started designing different types of products. And those products really morphed into two specific products. And today, there's probably, I don't know, Shannon, there might be hundreds, maybe thousands of different financial products that are in the marketplace.
Yeah.
But what I'm going to do is draw a little chart today that's really going to try to bring it down to two different products: permanent life insurance which would be the theory of buying and owning it. And then term insurance, which would be the theory or the reality of renting coverage. And when your rental term is up, the insurance goes away, or they reset the rates, and the rates go to, let's just think about it like a tariff rate, that they've published this rate with individual states. And by the way, life insurance is issued at the state level. It's not a federally mandated product. It follows federal tax rule, but states govern and appoint commissioners over insurance companies. That commission is called the NAIC, the National Association of Insurance Commissioners, and each state has its own commission or insurance commission, and we as agents, we're licensed by each state. That doesn't give you, you can get a license, and it's kind of designed to the lowest common denominator. So if you have a license, it doesn't mean you know what you're doing. It means you passed a test.
Right.
There's a significant amount of training that goes into design, structure, understanding. There are actually universities like UPenn who have an entire school for insurance.
Oh, wow.
And usually there's insurance and real estate, degrees.
Can an insurance agent be licensed in multiple states?
As a matter of fact, like we're licensed, I think, in
It was
about
a loaded
30,
question.
yeah,
But yeah.
30 some states. Our firm's licensed, so the company's licensed, and us as individuals are licensed in those states.
And we have to do that because if we speak to a person that wants life insurance, say in Wyoming, and we live in Virginia, legally we're not allowed to sell them a life insurance product unless we fall underneath the state authority.
Yep, we've paid the state their little tax.
Yeah, their dues, yeah.
Their pound of flesh, their dues, whatever you want to call it. And then you have to get appointed by your carrier you're going to use in that state. So it's a couple of things that happens with your agent. One, he has to be licensed in the state that the policy is being sold in. Two, the policy that they're representing, they have to have an appointment with that carrier in order to write that business. So we'll get into that, and we'll get into that a little deeper today as well, on how agents are compensated. And in the short answer right now is you're compensated by commissions. And so we'll break that down and give you how most carriers pay their agents and teach you about that. But where I want to start first is this history lesson. And what I'm going to do is fast forward from the 1700s and fast forward to about 1983. And I'm going to use the iPad here. Is that a capital S?
Nope, just a regular.
Okay.
Yep.
So you got the first code of Shannon's passcode here, everybody. So here we
You
go.
want to share that, Jake?
You'll need to plug it in.
Oh, yeah. Yep. There you go.
Okay. So what we're going to look at here is I'm going to really just try to draw you a picture.
There you go.
And I actually learned this years ago from a good buddy of mine named Don Blanton. Shout out to Big Don. And I thought it was one of the best illustrations of how insurance works in a modern world. Jake, are we up on this? Can you put it
I
up on
don't
the
see
screen
it.
here?
Let me come up and look at it.
Okay.
Looks like the box is off.
I can hide it, cut in what you did there. Like the way you're talking.
Should this box have green lights pumping on it? Thought I saw that.
Okay.
Golly,
Gracious.
freaking start getting sick again. I'm gonna shoot myself.
Don't do that.
No, it's-
That might be a little radical.
1 second. All right. And you can go now.
Okay.
So we're talking
what-
about Don Blanton,
yeah.
right?
So Don, he has shared with the world, and you'll probably, if you've been researching, you might have even seen this illustration out there of the difference between term insurance and permanent life insurance. So let's just say this line here, Shannon, represents term insurance. Am I going to be able to write here? So we'll call this term insurance. And we said earlier in the podcast that if you're buying term insurance, you're not really buying it, which would equate to owning it, but you're actually renting coverage. And you're renting or you're leasing that policy. And the idea here is that when you take that term insurance policy out from an insurance company, you're transferring your income risk, your asset risk. You're saying, insurance company, if something happens to me and I pass away, I want my beneficiary to receive this life insurance proceeds because there's an economic loss to that individual.
Mm-hmm.
Okay, so there has to be that economic loss. And in an insurance policy, there's really three people involved. You have the policy owner, right? That's the person who's buying the policy. You have the insured. They can be the same as the policy owner. And you have a beneficiary, okay? So those three people in the policy, two of those three have to have a common interest, right?
Mm-hmm.
That's the three-party rule. And we'll get more into that. That's kind of more of a podcast conversation. We get into tax planning. But the main thing here is that this policy owner and this insured has a relationship with the beneficiary. Mm-hmm. And if something happened to the insured, that beneficiary would receive typically a lump sum death benefit from the insurance company. And this line in the sand down here is going to represent premiums. And I'm sorry that my handwriting sucks. But when you think about premiums, term insurance would represent a low premium, okay?
Because you're renting it.
Because you're renting it.
Yep.
And the insurance company says, well, since this is going to expire at some time in the future, we're going to make the cost of insurance, which equals COI, is what you'll see on statements sometimes, cost of insurance. That's the risk premium that you have to pay in order to get whatever death benefit you've decided to buy. I guess it would help if I would spell better. So let's try death benefit. So whatever death benefit you're solving for, it can be bought with term insurance, or it can be bought up here at this line, which we'll just define right now as PLI, or permanent life insurance. Okay? So permanent life insurance, there's lots of different types of permanent life insurance. The one that most people lump into kind of all categories is whole life. But whole life is in and of itself a product that's exclusive from these other types, which could be universal life, index universal life, and variable universal life. Okay? In the permanent life insurance world, that's really what makes up permanent life insurance. But not all permanent life insurance is created equal. They all have little different design features that can be benefits, but can also be a transfer of risk by the insurance company to you, the policyholder, or you, the insured. Premium-wise, you need to think about this as it requires more dollars than term insurance. And why? Because it's going to theoretically, or should, if it's designed appropriately, it should last your whole life. Shannon, insurance is built on a 100-year chassis. Almost all policies issued. Premiums are going to be paid at least for the first 100 years. Now, I need to correct myself and go back to the year 2000. In the year 2000, there was a new study done by Harvard University called the Harvard Mortality Tables. And it reestablished life expectancy. Prior to the year 2000, life expectancy was built around the idea, the science, that everyone lives to age 100. Okay? So from IRS calculations to mortality calculations that insurance companies used, everybody in the world of finance was on the same page. Everybody lives to 100. After 100, all bets off. Everybody should be dead. By the 1950s, the 1970s, and then into the year 2000, we saw life expectancy charts in our country just ramp way up. In the 1930s, a male's life expectancy. Jacob actually fact-checked me on this. Let's go to the World Wide Web, and let's bring that up. And you could be doing this at home, but we'll do it for you. Bring it up over here on our Blackbox screen, if you would. Life expectancy for a male in the United States in 1930. Let's see what that says.
Sorry, one sec.
You might have to do some editing on this to speed this up a little bit. So life expectancy United States. Yeah, but I want to go back. You got to put it in by year. So life expectancy for U.S. male, 1930. Yeah, the little AI generator will pop up here. Yeah, there you go. 59.7 years. All right, change that to 1940, Jake. A male in the U.S. jumped to 62.9 years. By 1950, watch what happens here. That jumped to 65 years from 62. Remember where we were? We were in the 50s, right?
59.
Now, go to 1980.
72.
You got 198 point. There you go.
Oh, it's close.
Jumped to 73 years.
Yeah.
So, and again, this is the Centers for Disease Control and Prevention. We're seeing life expectancy ramp up significantly. There's a chart there at the bottom of the screens in the U.S., Canada, and United Kingdom. And it's funny, we're trailing those other nations. But what this
I wonder
showed...
what that big dip is right there.
Probably COVID.
Is that pre? What year is that? Yeah, that's
be.
interesting.
Got to be COVID.
Yeah.
And one of the insurance companies we work with, Penn Mutual, who, in full disclosure, is our go-to carrier that we use, primarily in most cases. The weird thing is that they didn't see a big decline in their, or a big increase in their death claims during COVID. And a lot of that goes back to underwriting and the health of their candidates who become policyholders. And the average age, I think, during COVID for death at Penn Mutual was like 88 years old. And I could go back and fact check that with the actuaries there.
But looking at this, we start in 1930s and we see, 59 and a half years life expectancy for a male. The insurance companies are paying attention to this every year
Right.
because it's in their best interest to understand to the nth degree the actuarial science behind how long an individual, male, female, could live.
So
And we're rated differently too from male and female, right?
So the cost of insurance over time has gone down since the 1930s because people are living longer. And that's science. It's everything from the advent of new technology to medications that have been brought into the marketplace that's kept people alive longer, even with dread disease. And so if we jump out to 2024, Jake, life expectancy in the U.S., 2024, 79.25 years. We're seeing now, and there's the Johns Hopkins report there, life expectancy years shorter in the United States than those people in England and other areas. And a lot of that has to do with our diet, okay? But I don't want to get off on a tangent there. What I want to really focus on today is that Jake put in Harvard mortality studies, 2000. So what happened, you can see here, is that the Harvard mortality tables, it became adopted that their studies and life expectancy for insurance companies moved from the age 100 to age 121. So any policy issued, I think, after 2008, by the time they got it adopted by most companies,
Runs out to 121.
runs out to 121 years.
Wow.
But in most companies, premium payments stop still at age 100, even though life expectancy runs to 121. The difference is term insurance, but most insurance companies who issue policies, their term insurance at age 95 goes away. Like, you can't have a policy anymore after age 95. But premiums, as we'll see later when we're going to show you some illustrations, are designed to be astronomical to basically
Force you out.
force you, right.
Just get you to say no.
Yeah. But to your point earlier, insurance companies are experts in death. They know the science behind who's going to live a long time and who has the risk of coming up short. And so what we want to do, and if we can bring up my little chart here again, Jake, what I'm going to show is kind of the thought here of how life insurance works. All right, so we've got down here at the bottom line term insurance, up here at the top line permanent life insurance. Now, something happened in the year 1983. In 1983, the insurance industry kind of lost a battle, if you want to think of it that way, with Congress and our then current president. So there were two periods, 1983 and then in 1986. There were two tax acts that changed the insurance industry. Prior to 1983, Shannon, you could go buy a life insurance contract with one single premium. And most wealthy people back then, that's the way they did it. For estate planning purposes, they would buy or own an insurance contract with an insurance company. So let's say and I'm just going to use some arbitrary numbers here. Let's say a person wanted a $1 million death benefit. Before 1983, a wealthy person would go to the insurance company, and they might shop Penn Mutual, New York Life, Northwestern, and they would go, who's got the best cost of insurance to give me a paid-up policy with just one premium? And so let's say they wanted a $1 million death benefit. A carrier may say to this client, okay, well, here's what it's going to cost you. If you think about premiums, you could pay us some term insurance for that $1 million, and we'll give you a 10-year policy, meaning the premiums will stay level for 10 years. Maybe we'll give you a 15-year policy, meaning they'll be level for 15 years, 20 years, maybe even a 30-year policy where the premiums are level. And then at the end of that 30 years, the coverage expires. Okay? So if you live longer than the coverage, what happens to your death benefit? Under term insurance, it's going to go theoretically to zero.
Mm-hmm.
You lose your death benefit. You paid all of those premiums in, and then it's gone. So that's one way you could have bought it in 1983. But you could also buy it. So let's use a buy example. So these same premiums, instead of that being, it's age-based. So let's say this was a 45-year-old male. Shannon, let's go through this and do a quick example. Jake, we'll bring this up and you can't bring it up on the illustration.
We can pop the HDMI over here.
Okay. What we want to look at is, let's put a 45-year-old male, and let's just say he's super healthy, and he wants to buy $1 million of coverage.
All right, you can bring me up, Jake.
So here's how this is going to be kind of outlined. First, we got to go pick the product, and let's just say this person's picking convertible term insurance, meaning during that rental period, they have the option to convert it to permanent coverage. And let's make them super preferred. Let's say they got the best ratings from the insurance company, or preferred plus in this case. All right, and let's start with a 10-year rental period. So what we're saying here, folks, is that they bought $1 million of coverage, 45-year-old male, and he wanted this coverage for 10 years. What would the premium cost be? And then let's go look at this policy. So this is the spreadsheet. Let's pretty it up a little bit. And why don't you blow that to like 120? There you go. That's good. So we can see here that this 45-year-old is going to rent $1 million of coverage for $573 a year out to the 10th year. And then something happens in year 11. What do we see there, Shannon? What's that premium?
Yeah, those premiums, good Lord, I mean,
they jump to $15,370.
Yeah, I was trying to do the math, and it's like a freaking 3,000%.
3,000% increase. Yeah. So those premiums significantly increase. Now, this is their published highest tariff premiums that they could charge you. It doesn't mean that they will charge you this, but it's what they can charge you guaranteed. All right, so that's the guaranteed contractual premiums. First 10 years, really, really inexpensive, but you're renting it.
Yeah.
And when your rental period ends, they go, hey, either you need to move out or you need to pay us up to $15,370 a year at age 56. And then when you turn 57, that premium jumps to $16,450.
Mm-hmm. And so on.
Folks, what this says to me is that the insurance company wants you to scream uncle. They want you to leave. They want you to give up the coverage because they know now that 56-year-old they could keep this policy, and scroll down for folks here, Shannon. They could keep this policy all the way out to, let's look, to 95 years old. And in the 95th year, the insurance company for 1 year could charge you $856,420 premium. And everybody laughs. Everybody laughs.
Yeah.
Because if you kept the policy that long, it doesn't take a whole lot of math to figure out that you way
Paid more
overpaid, way overpaid for that $1 million coverage.
Yep.
That never increased in face value. It never went up. So that would be idiotic to do. No one's going to do that.
So then you have a couple of options, right? You have
Yep.
a 45-year-old who can say, hey, give me 20 years worth of term insurance.
So I think I need it. I have a need.
Or you have a 45-year-old that says, no, give me 10. And then after the 10th year, he can go, all right, let's go for another 10 years.
If he shows evidence of insurability.
Insurability, yep.
So if you want to go past 10 years, folks, what they're going to say to you here is you have to show, again, evidence of insurability, meaning that you rate the coverage. So let's look at the other option. The person says, well, $573, that's not that expensive. What if we did a 20-year and we rented it for 20 years? What is that going to cost? And we could do 15, but we'll just skip that one. So that's going to be $1,070. Again, bring it up on the ledger so we can look at it.
Remember, this is annual, right?
Right. This is an annual premium. And by the way, that's a great point. When you're paying premiums, you have the choice to pay the insurance company monthly, quarterly, or semi-annual, or annual. Each one of those, other than annual, has a finance cost. Go up to policy overview, and we can see that policy cost. And what you will see here in those monthly premiums, there you go, that you paid the insurance company $104.48 more for that same premium. So if you think about the base premium being $1,070 a year, and if you pay them monthly, you paid them $1,104. So you gave them some additional interest, some additional money.
And then you look at that over a 10 to 20 year time period.
Yeah.
You're looking $300 up to $3,000, right?
For the same coverage.
Yeah.
So if you can pay it annually, you should.
Yep.
That's the rule of thumb there. Don't give the insurance company any more than what is necessary to provide the coverage.
They'll take it.
They'll take it, and they'll finance it for you,
Yeah.
but it can get expensive over time. So after 20 years, what happens here? There you go. There's the tariff rate, jumps to $35,890. So they're saying, hey, well, let's just say you did it 5 years after the period ended. You've given them 35, 39, 43, 48. You've given them almost 1/4 of the value of your policy in 5 years of premiums. So you're renting the coverage again. Nothing good happens from this. Mm-hmm. Now, let's look at the other side of the scenario here. What if, and we're just going to build a basic whole life chassis here. So let's go in and look at, when I'm showing you this chart earlier where I drew the lines showing term versus whole life. And I'm just going to pick whole life. And this is a dividend paying whole life contract issued by a mutual company, which means you own part of the company. We'll get into that conversation a little bit here in a minute. And Shannon, let's just say the premiums are paid all the way out to age 100. We're not going to do anything fancy here, folks. We're not going to overfund the policy. We're not going to pay it. We're going to say, what happens if you pay these premiums from 45 to age 100? Let's see what would happen. So now what the computer's doing is saying, okay, this 45-year-old, and this is a just bare bones, straightforward policy, you've got to give the insurance company $20,000 a year to buy $1 million death benefit. And if there were never, ever any dividends paid in this policy, that might be a little expensive. That might be a little rough. However, let's just go examine that. If we went out to, let's go 20 years, by the 20th year, you've given the insurance company $400,000. Okay. Go to the basic ledger. There we go. And so this basic ledger on the left side of the screen, and on the left side of the screen, I'm seeing the non-highlighted side where it's white and where it says guaranteed. So when you see guaranteed in a whole life contract, this assumes that there's no dividends ever paid in this policy. It's just the guaranteed contractual benefits of an insurance contract. And that guarantee is simply this: you give us $20,000, we promise that you'll have $1 million death benefit in all years. It won't increase, but it's $1 million flat. So you're self-insuring this contract each year by $20,000. By the 10th year, you've given the insurance company $20,000 a year times 10, $200,000. And your cash surrender value, if you want to move it over right there, Shannon, the total guaranteed cash, no dividends paid, $141,060 is your cash surrender value. What that means, folks, is that if you walked away from this insurance contract, the insurance company's giving you back, of the $200,000 you paid in, they're giving you back $141,000. But I want to show you something that's kind of interesting here. If you jump out to year 12 at 57 years old, under this company's guarantees, and again, excluding dividends, no dividends are paid, you've put in $20,000, and in the 12th year, contractually guaranteed, what are we seeing happens there in the guaranteed increase each year, Shannon?
It starts to jump up more and more.
Yeah. So by the 20th year, you give the insurance company 20, and your cash surrender value goes up $20,130, contractually guaranteed. Now, this is not an investment, but if you were just buying the insurance, you can see now what is the cost of insurance on your premium for you, the consumer, each year. Your cost is now negligible, meaning that you've given them 20 and your value of your contract went up by $20,130. So the return you got on your money was $130.
$130, yep.
We're not setting the world on fire with that.
Right.
But this continues to happen. So let's go out, let's go to the 30th year. In the 30th year, you've now given the insurance company $600,000, all right? So you've self-insured $600,000 of the million. Does that make sense to everyone?
Yep. So every 5 years, you're giving them $100,000.
$100,000. But your death benefit hasn't increased. It hasn't moved. So there's a point where you're going to go, hey, I'm really self-insuring here. And this is assuming there's no rate of return. It's just a guaranteed base principal with a little bit of interest being earned there. But it just right now, you're still underwater. You've given them $600, but your cash surrender value, if you can highlight that on the screen, is $557,450 guaranteed.
This number right here.
Right? You gave them $20,000. Your policy went up by $20,990, assuming no dividends. And again, assuming the death benefit has not increased. Now, this is why dividends in a mutual company matters. So when we talk about dividends, or you hear about a company paying dividends, what's important to hone in on is, well, what is a dividend? A dividend, by definition, is a return of premium. And it's a return of premium at interest and a recoupment of mortality cost. So if you're with a mutual company that's participating, a mutually owned, participating, dividend paying, same word. If it's participating, it means they pay dividends. It doesn't mean dividends are guaranteed. But here's what's interesting. I went back and did a little research on mutual companies. And on mutual companies, going all the way back to the 1700s, I need to find my notes on this, but going all the way back to the 1700s, what's interesting, Northwestern Mutual, Mass Mutual, New York Life, Guardian Life, Lafayette Life, they are 6 of the top mutual companies in the United States. I want to read this to you, Shannon. Northwestern Mutual, founded in 1857, and I'm going to talk about dividends here. Dividend payouts every year, so they were formed in 1857, Northwestern Mutual. Dividend payouts every year since 1872.
Wow.
The 2024 dividend payout total to all policyholders for Northwestern Mutual was $6.1 billion. Their dividend rate in 2024 was 5%. Mass Mutual, founded in 1851. Dividend payouts every year since 1869, meaning they haven't missed a dividend payment since 1869. 2024 dividend payout, $1.9 billion. Their dividend rate was 6.1%. New York Life, founded in 1845, they have paid a dividend every year since 1854. Dividend payout in 2024, $2.2 billion. Their dividend rate, 6.1%. Guardian Life was formed in 1860. They've paid a dividend every year since 1868. So 8 years after they were formed, they have never missed paying a dividend. $1.3 billion in 2024.
Wow.
Their dividend rate in 2024 was 5.9%. My favorite company, and I'll put it out there, all right? I can work with any of these companies except Northwestern Mutual. They won't work with independents. You have to be a captive agent. We'll tell you what that means later.
Yep.
But Penn Mutual was founded in 1847. Penn Mutual has paid dividends consecutively for 175 years. So when you do the math on that, it means they missed the first 2 years of their formation.
Jeez.
And they've paid a dividend every year since. Now, they're a little smaller than these other big companies, but their dividends exceeded over $200 million in 2024. The dividend rate was 6.1%.
I think that's actually been their 10-year average. Or
Yep.
6.15% was their 10-year.
So that dividend average matters. And if you think about what's happened with interest rates in the last 10 years, they've been extremely low.
Mm-hmm.
But insurance companies specifically mutual companies in their whole life are participating dividend-paying carriers. You've seen dividends in the high 5s to low 6s. In the 1980s, before this Tax Act changed in 83 and 86, dividends were double digits because interest rates were double digits. But inflation
Was also rampant.
was double digits. So it's an inflation-adjusted dividend typically. It is a interest-sensitive dividend.
Yeah.
Oh, you were going to say something?
Yeah, I'm just thinking, well, number one, I mean, adding up, just those 5 companies, that was like 13 or $14 billion paid out in 2024.
To its mutual policy owners.
Yeah. It makes me wonder, like, when you look at the securities world and the companies that pay dividends, like a company like Apple, I think Apple has a dividend, or Amazon, Netflix, whoever, it makes me wonder how much they pay out a year.
Yeah.
In comparison, right?
Yeah.
Because you have one group of financial securities, right, that are correlated, as we talk a lot to the stock market, so ups and down in the market. Dividends will probably kind of go up and down with that.
Yeah.
Earnings per share, how the company's doing, versus you have a mutual company that's not correlated.
Yep.
That has paid dividends for 170 plus years.
Yeah.
That's pretty wild.
It's amazing.
In an astronomical amount.
And this is what I want to go do now. I want you to go back into the software, and I want to show consumers, and I want to show people who are watching this today the power of dividends within a policy. So if we had stopped at the 20th year, I think.
Yeah.
If we look at the 20th year without dividends, the cash surrender value in this policy was $345,000. The increase in cash was $20,640 a year. But when you include dividends back on the far right of this column in the screen, that cash surrender value now jumps to $590,899. The dividend plus the guaranteed increase in cash was $48,829. The death benefit increased from $1 million to $1,402,715. So Shannon, do this for me. Go back into your case design, and let's just go to the 20th year, because we rented the policy for 20 years, right? Mm-hmm. And then we said the person let it expire and go to zero. So let's take that policy. No, don't do it that way.
No, sorry.
Just go to, I want to illustrate reduced paid up. So what I'm saying here, folks, go to 21. There you go. What I want to show here is that this person in the 20th year, when they had the term insurance, they decided to do a paid up policy so that they wouldn't put out any more premium. So they gave the insurance company $400,000. Okay, and let's go down to the 20th year here. Go to the supplemental page, because it'll show it, our design here. So they gave the insurance company $400,000, and we can see on the far right column that death benefit in the 20th year was $1,402,715. But there's this term called reduced paid up. This is a provision and only a privilege that you have contractually in whole life insurance, which is one of the reasons I love it and like to use it. So here's what we're saying. We're saying, hey, insurance company, we're going to take our $400,000, we're going to leave it on deposit with you. What is the minimum death benefit? Not the maximum, but what is the minimum death benefit you will let me keep where I can self-insure my $400,000 with you? How much death benefit will you give me in exchange for my $400,000 staying on deposit with you? Think of it that way. Insurance is premiums, but I'm going to think of it as premium deposits. You've deposited $20,000 of premium over 20 years. So the insurance company's holding your $400,000, including dividends that we showed at non-guarantee, but now we're showing it as if it's in the policy and they were paid every year. And if a company's done something for 175 years, there's a pretty good chance that it should continue to pay dividends.
Yes.
That they're doing something right. And all of these carriers, we could say that about. It's not exclusive to Penn Mutual. But if we looked at this policy, he's got $400,000 put in, $590,000. Now, if you're doing a compounded annual growth rate, you can see that's not setting the world on fire. It's not a great return on investment. I'm not here to try to tell anybody that it is, but anything after the but in this case, it's pretty cool. Yeah. And I want to show you why. It doesn't stink.
Yeah.
Shannon, you got your phone handy? If you don't, I'll do it.
Didn't bring it with me.
Okay, I got it here. Here's what I want folks to do at home. Highlight in the 21st year, the increase in cash was $33,641. Now, you paid in $400,000. So I like to refer to this as the yield to premium. The insurance contract, without you having to put in another dime, yielded you $33,641.
It's like 8.1%.
So if we take $33,461 and we divide it by the premium you gave them, that gives you 8.365%. That's your yield to premium
In the 21st year.
in the 21st year.
And then it continues to grow.
And as you hold the asset, it's going to continue to grow as long as dividends are paid. It's going to continue to grow. The death benefit will continue to grow. The asset will continue to grow. And this is what I like to refer to as life assurance. And if you design, and we haven't done any special design here. This was just base premium going into an insurance contract. And I don't want to go in and illustrate special designs like you'll see people do on the internet, because everybody's number is going to be different. Everybody's design is going to be different. But there's typically some tests that we have to follow. There's a CVAT test and there's a GPT test. CVAT's the cash value accumulation test. And then there's the guaranteed premium test. These two different tests that I'm talking about, those were set by Congress in 1983 and 1986 under two tax acts. You can go look them up if you like. The TAMRA and the DEFRA tax acts. I call them the ugly twin sisters. Okay, these two tax reforms changed how we used to buy life insurance, and specifically how wealthy people bought life insurance prior to 1983. Remember, probably 30 minutes ago in our podcast, we talked about
Single premium.
single premium. Single premium was ripped away, and now you have a cash value accumulation test that we have to follow. And the bottom line is that there's a 5-pay, 7-pay test. And it says that basically if you put more money in the first 5 years or in the first 7 years that exceeds the single premium guideline test, then you have violated the insurance contract as insurance, and now it has to be classified as investment, or another word is MEC, and it's an acronym that stands for Modified Endowment Contract. A MEC policy means simply that anything above your basis that you've put into that insurance contract, if you ever surrender it or take your money out, you're going to pay tax on it. It follows FIFO rules, first in, first out rules. We want to use LIFO, last in, first out rules, meaning we want to get our basis out first and then take, theoretically, loans on a policy to be able to preserve tax-free use of the policy. Now, I'm sharing a lot of information with you today. This is where the reports that I'm going to send to you that'll be put in links. This page will help you understand that if you're researching this.
So then how can people use the cash value in these products?
Yeah, it's a great question. The cash can be used any way you see fit, as long as you don't violate the MEC limit. And that MEC limit is very simple, very straightforward. It's actually laid out in the policy. Go back into, go to policy overview, hit that button. And then let's scroll down until we see tax distributions. All right, and what illustrations, this is Penn Mutual's illustration, but what most illustrations are going to show you is a column for tax distributions. And when you look at that tax distribution, it's going to outline for you. Keep going. It'll come up here in just a second. There's the dividend options, non-forfeiture options. There we go. Important tax information. So let's read this to you. Any references to the taxation of life insurance products in this illustration are based on Penn Mutual's understanding of current tax laws, and replace Penn Mutual with whatever carrier you want to put here. They're going to give you this disclosure. In order to receive favorable tax treatment of distributions such as policy loans, paid up dividend surrenders, a life insurance policy must satisfy the 7-pay premium test. And this is the one they're using. It's kind of their corridor that they're going to use to define the premium. So $56,303. If you go over that number in the first 7 years of premium payments with excess premiums, it's going to be violating the MEC limit. So it goes into play with how much premium you're putting in. And if you put in more than $56,000 over that 7-year period above your calculated basis for the initial premiums, you're going to violate the MEC limit. You're going to violate that test, which means it's going to become a MEC. And so we have to stay, if you're going to put extra money in, you have to stay below that guideline premium in order to do that. And if you violate it, it will show you in an illustration, and it'll have...
Yeah, it'll tell you real quick.
Yeah, real quick, you've made it a MEC. Are you sure you want to do this? So the idea, if you're going to buy life insurance, let's go back to the supplemental page. If you're going to buy it, in an ideal world, the supplemental ledger where we had reduced paid up. There we go, 20th year. So in this example here, folks, this person who had $1 million of term coverage decided in year one, instead of buying term, we're going to buy plain old dividend-paying whole life. And we're going to give the insurance company $400,000 of our money over that period of time, using this example here. But they have the liquidity, the use, and the control over that money. Insurance companies typically will give you access to your money at about a 95% value without lapsing the policy, meaning whatever the stated cash surrender value is, if you multiply that times 0.95, that's how much you can take out of that policy without theoretically lapsing the policy. Now, if you took that much out, you'd probably have to do it as a policy loan, because your basis, anything above your basis, what you've put in this example, $400,000, you would have to do it in the form of a policy loan to keep favorable tax treatment, or to keep it, I like to say, tax preferred.
Yeah.
Right? Versus tax free, because you can screw up tax free if you take too much out and you let it lapse and you don't pay it back, and policy lapses. If you don't have riders like an overloan protection rider built into a policy, you can end up owing some income tax for that difference between your $400,000 in this example and the cash surrender value you took out. So again, these are things you need to understand how to use and how to utilize a policy if you're going to use that cash surrender value in your retirement years or in any time during your policy phase. But if you think about an asset, in many cases, this could be the idea. Some guys will talk about using life insurance as a bond replacement in your portfolio. So if you're thinking about bond yields, you could use life insurance as a way to offset the idea of having to have bonds in your retirement years. The life insurance,
Contractual versus non-contractual, right?
right,
Yeah.
could set up this opportunity for you to have a tax-deferred, tax-free growth on your life insurance cash values, while the death benefit stays income tax-free to your beneficiaries. And you create an environment where this money now grows very tax favorably, and you theoretically don't have to have as many bonds in your portfolio to offset investment risk. So that's something you should be considering and talking to with your investment advisors. Well, here's the crazy thing. Investment advisors typically don't want to tell you to do that, because if they're not utilizing life insurance inside their practice of retirement planning, you're not getting the full scope. You're not getting the full picture of how it could be used in your later years where you might not, quote unquote, need the death benefit anymore.
Right.
I ask this question simply of every person. And I'll ask you today at home when you're thinking about this. If anything in life was free and it was something you wanted, not needed, but something you wanted, if it was free, how much of it would you have?
As much as you could.
Right.
Yeah.
So let's think about it in the form of life insurance. Most of us use a needs analysis. We go, well, you know, I've saved and I've invested enough where I don't need the death benefit anymore. But if you theoretically think about that death benefit as a replacement of income, how much of that death benefit can you spend if you rented the term insurance and now you have the investment to replace it? Well, you can't spend any of that investment because it's the death benefit.
Right.
You're self-insured.
Yeah.
So why not create an environment where if you're going to do that, buy the insurance with dividends, even though they're not guaranteed, the dividends from quality mutual companies. There's a track record there. And if you were talking to an investment professional, they would say, you go back and look at and study investment yields and investment returns from companies that have a history of performing well, and it gives you a certain amount of assurance that history is going to do what?
Repeat itself.
Right.
Yeah.
So if you find quality companies that are paying dividends, the likelihood of that continuing to happen is pretty high with quality companies. Buy A+ rated companies, buy A companies, A- even. I would try to stay away from the Bs.
Yeah.
And definitely the C's and D's.
You want a company that has staying power.
That's correct.
Right?
Absolutely right.
Yeah.
So design is what's going to be important here. What we showed today was a basic chassis and a basic design of a life insurance contract for term versus whole life. Now, how you fund, $20,000 versus $500
Just getting ready to ask you that question.
or $1,000, that depends on your assets.
Yeah.
That depends on how you've saved prior to this purchase or how you want to save moving forward. That's going to depend on each and every scenario and each and every person and whether or not it's actually a good fit to do this. That's where the answer may actually be term insurance.
Yeah.
It may be invest more, do term now, and then later convert.
So thinking about this from a 45-year-old perspective, I mean, that's kind of what I was going to ask you is, hey, 20,000 is a lot, right? A year, annually. But then, maybe some of the people watching at home are 60, 65, and maybe their thoughts are, I'm too old to purchase, life insurance. What would you say to them?
Don't throw the baby out with the bathwater. Go examine it for yourself. If you're in relative good health, meaning you could get a standard rating or better, I would say give it a strong look.
Yeah. Be
Be open-minded to how it can be used, and then literally do some comparisons.
Yeah.
Do some comparisons against your equities, your bonds, your money markets, your other investments, your real estate, and see where it fits in the overall plan. It should be considered as a part of your process, not solely just as a product purchase. If you're going to compare the life insurance to an investment vehicle, most investments are going to outperform the rate of return. And that's not what we're trying to compete against. We're trying to compete in a process-driven approach of how does this work when it's harmoniously designed with every other investment product, whether you're 45, 55, or 65. Can we still create a plan or strategy that utilizes an asset that could be an asset class replacer? Meaning we're not going to try to compete with equities. That's silly.
Yeah, and we talk a lot about buckets, right?
Right.
This is merely just another bucket.
That's right. It's a
Right.
great point.
Yeah.
Use this bucket to buffer against market volatility.
Yeah.
So if I've got something that's not going to be exposed to market volatility, it could be a place that we go to in the distribution phase to pull money from when our equities portfolio is down. And we'll do another podcast of where we bring together like an insurance scenario
Yeah.
with an investment scenario, with an annuity scenario, kind of like the white paper that you're going to see in the link here at the bottom of the page from Ernst & Young.
So, sorry, a
Go ahead.
thought is, and kind of going back to the beginning here, in life insurance being that in which protects your assets and income in life, right?
Yeah.
If a person fits this whole life, there's really kind of a transfer that happens once you hit retirement,
Yeah.
right?
Yeah.
Because your assets at that point probably close to being paid off, or you maybe the thought process changes to, hey, I'm going into retirement, so I'm maybe reaching my distribution phase. So the transfer being from assets, income, and life to ensuring your retirement.
Yeah. It's
Right.
a great point.
Yeah.
So the thing that I would add to that, Shannon, would be as you're going from the accumulation phase, going up that financial mountain we talk about, and you get to the pinnacle of that mountain that most of us refer to as retirement. And that retirement can mean a lot of different things to everyone. But in most scenarios, what retirement really means is that now we're shifting from our wages providing the cash flow to now our assets, our investments, our insurance is providing the cash flow. We talk to our clients all the time about income is everyone's outcome. It doesn't matter if you're Warren Buffett, Elon Musk, Shannon Shortridge, Kenny Porter. Income is the outcome, or maybe a better way to say cash flow is the outcome. If you don't have positive cash flow during your distribution phase, you probably can't stop working at whatever job, J-O-B, you're at.
Yeah.
But if we can create the assets in a way that they replace the income that you had in your accumulation phase, that's ideal. Now, if your income or cash flow in the retirement distribution phase is too exposed to too much volatile risk, that's called sequence of returns risk. We have to have a source to offset that risk. And it doesn't matter whether your source of income comes from real estate, from stocks, bonds, mutual funds, exchange-traded funds. We have to have non-correlated assets, or we call it the jar in the yard. But if I got a jar in the yard, AKA some life insurance cash values, that can provide a benefit when...
Or even a dividend.
Or even a dividend.
$33,000 annual.
Right. Lots of options. We want to have more options than less in our distribution phase. We want to be able to be nimble when markets change or when our situation changes.
Yeah.
And I'm thinking about, I've got a client coming in today who just lost her job. And we have a big permanent life insurance policy. The first thing she asked in an email was, Kenny, what are we going to do with that? Because the fear comes in, I've got this premium I have to pay. We have options. We have multiple options, just like you do if you were putting money in a 401k. If you got to stop saving in the 401k, you got to stop saving here. What options do we have to slow the burn rate, to slow the distribution of required premiums or savings? That's part of a plan, and that's part of strategy that has to be considered in all phases of life.
Yeah.
And so here, what we're saying today is just we want to give our viewers, our clients, our new potential clients, the idea of how would we integrate life insurance into your plan.
And I think one of the biggest pieces with that is it's part of the process.
Bingo.
We said it earlier, this isn't for everybody.
Right.
And it's not a one size fits all.
Yeah.
But if in our process of planning this comes up, we only bring it up because it makes sense.
Yeah.
Right?
And it has to be a conversation. If you want a person to be a true advisor to you, shouldn't that advisor be considering all aspects of financial products and financial rules and looking at it in your specific process? And if you don't have a discovery, and if you don't discover whether that makes sense or not, then I think you could be exposing yourself to risk unnecessarily.
Yeah.
And I think it's also important in closing today is that just because an advisor brings it up to you doesn't mean that they're always just trying to pitch you or sell you a financial product. There has to be that trust bridge has to be built. Those conversations need to be had. But one of the things I want to end with today and share with consumers is, well, how do agents get compensated for this stuff? How are they getting paid? And as an example, in this product that we designed today, In most illustrations, there's always going to be what's called target premium. So that target premium that you are showing at the top of the page there with your arrow, that is what insurance companies tell the consumer what the potential commissions could be paid on. So target premium is always the guideline. So you can see in this case, target premium exceeds what you'd actually pay on this. So this means every dollar that was paid in premium here was commissionable to the agent. Sometimes you'll see target premium that's lower than the actual premiums that are being paid. It's because of design and how the agent's designing it. So if you're trying to overload with cash and you're trying to get cash into a policy earlier, then you would see a lower target premium typically. And that's because the agent is designing the contract with more what's called PUA or paid up additions or overfunding of cash in a policy. So lower target premium means lower commissions. And the agent should be talking to you about how they get compensated. Most agents, depending on whether they're a captive agent or an independent agent, the basic chassis for insurance companies is that year one, your first year premium is going to have a commission rate typically of 50 to 55%. There might be occasions where it's lower than that, might be occasions where it's higher. Some agents, depending on the insurance contract, most chassis of insurance companies are built around, Shannon, a 140 to 145% chassis. I even got a friend right now that their chassis is built on 150%. But each state, New York being the chief of this, can tamp that down. But insurance companies have a distribution problem. They have a problem getting their product out into the marketplace and getting agents to sell it. And it's because in the financial services industry, our statistics of survival rate is really bad, right? Most agents who come into the industry, most financial advisors who come into the industry, most being calculated at 93% of those who are in the industry in year one. By year 5, 93% of them are gone.
Wow.
So very, very high attrition. It's worse than special forces, man. So the people that
game.
they don't hang around long.
Yeah.
And so it means that insurance companies have a higher distribution cost, the agent, to promote their product and how to use it with consumers. And it's not a one-size-fits-all. So they pay a lot up front. And that sometimes can bring charlatans to the table or guys are just trying to take advantage of their clients. But what's important to understand here, folks, is your agent, is your advisor giving you full disclosure? Are they being transparent with you? Are they sharing with you how they help you, how they're getting compensated? And it comes back to a value proposition. The thing that we share with our clients, friends, family is that anything in the absence of value is expensive.
Yep.
So if it's not a valuable proposition, if that doesn't add value to your life, don't buy it.
Yeah.
Run the other way.
Yep.
But before you run, you should at least have a conversation with an advisor that you trust. If the trust bridge is not there, run. I don't care if it's me, you, Joe Blow on the street.
Yeah.
You have to build a trust bridge, and that you have to trust that that person has your best interests at stake.
Yeah.
And if you do not believe that, and you can't verify that they do, go the other direction.
Yeah.
And find someone who can help you. But it's important to use quality companies, quality ratings. And I can tell you on this show today, I don't mind telling you, at the top of my list is Penn Mutual. I'd say right up there with Penn Mutual is New York Life, Mass Mutual, Northwestern.
Yeah, the ones you were
Lafayette
talking about
yeah,
earlier.
the,
Yeah.
kind of the big six,
Yep.
the top six. And there's other quality ones out there, but they're the ones that kind of meet our threshold for who I would be proud to do business with. Or if I see them coming to my office and they have one of those institutions, rarely do I recommend a client change or unwind them if they're designed appropriately. Design matters. And today, we just did a very simple, straightforward design. We didn't do anything fancy that can be done to mitigate premium payment periods, maximize the time of payment going in. And if you're looking for cash accumulation, what you're trying to do is put in more premium and reduce your face amount so that you have, sounds weird, so that you have a insurance policy that feels and looks more like an investment than an insurance policy, even though it's not.
Right.
So design matters, and it matters to what you're trying to accomplish. So again, it's not one size fits all.
Right.
That's our conversation we wanted to have with you today to kind of lay things out for you. We can go much deeper, and we can get into, the TEFRA or TAMR and DEFRA acts. We can go into cash value accumulation tests, guaranteed premium tests. Those are things that we would say reserve for those individual conversations because it matters in your design. And we could go through a multitude of different designs, but it comes down to really, number one, what do you want versus what you need? Let's start with wants and needs.
Yep.
In an ideal world, what would you want to have happen? In an ideal world, what would you want your life to look like without you being there? What would you want to have happen with your family, with your loved ones, with the institutions that maybe you would want to pass money on to philanthropically? Those are the things you really just need to discover and think through for yourself. But if you end up just going, hey, I don't want any of that, I don't need any insurance, oh, awesome. You're not a candidate to do this.
Right.
Move on with life with what it is you want, not what you need. And I think that'll solve a lot of problems for a lot of people.
Yeah, absolutely.
Anything you want to add in closing, or?
I had one little thought there at the end was, and I'm thinking back, I retired on July 1st last year, and that survivor benefit decision was one of the bigger ones that I had to make with my wife. And going this route made sense for us. It doesn't make sense for everybody. But I would just say, if you're in the military and you're watching this or you're getting ready to retire and you have that decision coming up, find somebody who's knowledgeable in this realm. Have that conversation of, do I go survivor benefits? Do I go life insurance side? And understand that, as much as you possibly can. Yeah. Find somebody who can educate you on it.
Yep.
But other than that, I think that was a good, really good explanation. I learned a lot, as I always do. What's on the docket next time we come back?
Yeah, we're going to come back and we're going to talk about the other taboo, annuities.
The A word.
Yeah, the A word. And annuities, again, a lot like life insurance, has massive misnomers, but it also has some flaws. And most of the flaws come from the agents who represent the annuity versus the product itself.
Yeah.
But there's some design out there. There's some crappy design out there, and it again comes back to quality. Find quality, work with someone that you trust, and make sure that they're giving you the full disclosure.
Yeah.
And if you do that, annuities could be a good tool in your financial toolbox.
Yep.
In the distribution phase. Wouldn't say so much for the accumulation phase for 99% of people, but if you're headed into the distribution phase, there is a compelling argument to own some annuities, and we'll help unravel why.
And there's some cool strategies that we'll probably talk about as well.
Yep.
Yep.
Cool, man.
Cool.
See you in a few.
Yeah.
Blackbox.